deal. All right, so we went over the technical side. So the other way we can analyze stocks is fundamental. And again, this is more so for your long-term people. If you're just going to be in there for a couple minutes, you definitely don't need to pull up the 10K, the annual reports, anything like that. But this is still super important. So one of the things you want to think about with your long-term approach or your long-term investing is your approach. The first thing to consider is how like what you want to invest in. Like, do you want to do individual stocks? Do you want to do ETFs? Some people are way more active in their managing of their portfolios. Some people are more passive. Doesn't matter. There's so many ways to kind of attack this depending on your personality and your lifestyle and your financial goals. But some of the statements you can kind of ask yourself are like, are you analytical? Do you like crunching numbers and researching? How much time do you have to dedicate to the stock market? How do you like to read and really dive into things? Or do you just not have time? Are you super busy and you just don't have time to kind of do a deep analysis on stocks? Regardless, investing in the market is for anybody. It really is. All right, so there's different ways to invest. Again, you always want to diversify. You have individual companies, you have index funds, like your ETFs, you have stock options, you have dividend stocks, commodities. Commodities are ripping right now. That's like your oil, your gas, your corn, your wheat, your lean hog. We made a joke the other day. People were calling them old man stocks, but they're making money, right? So the goal is to make money. It doesn't matter if you enjoy it. Who cares about corn, but it's ripping, right? So just make money where the money is. You have real estate and you also have cryptocurrency. All right, so again, decide how much you want to invest. Again, don't use money that you're going to need in the next 5 years. While the market is almost certain to rise over the long term, there's a lot of uncertainty, right now in the short term. A 20% drop in any given year isn't unusual. That I guess this is our year. So make sure you're not investing your emergency money you need for tuition, vacation money. If you're about to buy a house or a car, that money should not be entered into the stock market. So what do you want to do with your investable money? It's called asset allocation. A lot of factors come into play, like your age, your risk tolerance, and your investing goals. That's going to be different for everybody. One thing to remember when you're in the market is to run your own race, focus on growing your own portfolio. Don't compare yourself to other people. A lot of people are trading out of accounts that they've worked their whole lives to build, like their retirement accounts, things like that. So if you're brand new, like in college or what have you, you can't compare yourself against that, right? People are working with different amounts of capital and things. So always remember to focus on your own situation. The general idea is that as you grow older, you want to be less aggressive in your investing, right? So, but you can still, there's nothing wrong with scalping. I know we have a student, I think she's 79, and she scalps with us. So there is no age limit to this. But again, the idea is that you want to build up this retirement account so you can enjoy it as you get older in age. Things to consider before you start: company structure and revenue, company's profits, their growth over the years, their debt, corporate governance, who's in charge, and their turnover rate. Also, the performance of the overall industry, trade agreements and politics, that's huge right now. The company's financial statements, press releases, we get those every second of every day. News related to the company, and also competitor analysis. I think competitor analysis is one of the biggest things that we need for fundamentals. You have to have something to compare the company to, right? Just to see how they're performing against their competitors. Also historical data, publicly known information like SEC, those are huge things. Let's see. I see someone with their hand up. Did you have a question? Feel free to drop it in the chat if you have a question. I'm happy to answer any questions. All right, so opening an account, things to consider. There's different types of accounts. You have your standard brokerages, you have your IRAs, and you also have like 401ks. They all allow you to buy stocks and mutual funds and ETFs. Really what you want to ask yourself is how easily do you want to be able to access your money? If you're someone like, when I first started, all I had was a standard brokerage. I was trading when I first started trading full time. I was paying bills with that money. So like I would trade, I would take some money out each Friday, like a little paycheck for myself. I had a whole plan and budget. And so I started off trading out of a standard brokerage. As I grew my account, I actually eventually started trading out of an IRA. And now I don't pull money out as often, right? So now I'm just building up that IRA, and I don't withdraw the money out of there at all. I just like to keep it in there to grow it. All right, so this is just a quote I found, but a $10,000 investment in the S&P 500 50 years ago would be worth nearly 1.2 million today. And that's literally just buying and holding in the S&P 500. All right, so probably need to update these, but this is a screenshot of my business partner's portfolio. Time in the market beats timing the market. Again, this is just shows you the power of buying strong companies and holding them. So this is Apple. This is the average cost, 61.82. At that time, Apple was trading around 175. AMD, $20. At that time was trading around 145. Microsoft 118, at that time 334. Amazon, this I'm insanely jealous of this, but average cost is 767. At that time, Amazon was at 35.19. And then of course there's Tesla, 225 average cost, and at that time was trading around 1066. Of course, these numbers will be adjusted to the market. We are in a bit of a dip, but nonetheless, these average costs, you can weather the storm, right? You can weather the storm. The market will recover, and onward and upward. Forward is the motion. All right, so this is a quote I love from Warren Buffett. You do not need to do extraordinary things to get extraordinary results. We're literally just buying and holding strong companies. So this is just a list of retirement planning apps. If I had to pick my favorites off this list, probably M1 Finance and Vanguard. Those are my top two favorite retirement apps. All right, so we went over the brokerages. And again, a lot of these do offer their retirement accounts, like Thinkorswim does, Fidelity, Schwab, E-Trade, Webull even has IRAs. Robinhood does not. So if you're someone who's trying to plan for retirement, this is not the one for you. So just keep that in mind. I do not recommend leaving large amounts of capital on Robinhood. All right, so choosing stocks. Remember, you want to diversify your portfolio. Only invest in businesses you understand. When you're first starting out, you do want to avoid like high volatility stocks until you get the hang of investing. You definitely want to avoid penny stocks like the OTCs. There's a lot of people that are interested in those, but when you're talking about your retirement account, if you have a stock that's like below a penny and you dump all your money into it, you don't want to be ready to retire and all of your money, your stocks are still below a penny, right? You want to make sure it's something strong that's going to grow over time. So that's really not something you want to be heavy in your retirement. And again, learn the basic metrics and concepts for evaluating stocks. And that's the fundamentals that we're going to go over. All right, so growth versus value. Growth stocks, they're going to exhibit above average revenue and earnings growth potential. Identify powerful long-term market trends and the company's best position to profit from them. You want to narrow down your list to businesses with strong competitive advantages. And then you want to further narrow that list down to companies with large addressable markets. So think about Amazon, Netflix, Shopify, Facebook, Tesla. When you pull up a chart on these, like a 1-year chart, it's like a skate ramp, right? Like it kind of just like creeps up and then it shoots straight up in the air. These growth stocks, people are so confident in these companies that they've bought them up at these extremely high prices. And they have really high PEs, a lot of them, but we'll talk about that in a minute. But nonetheless, the reason they're so high is because people believe in the company. The flip side, you have your value stocks. So value stocks present an opportunity to buy shares below their actual value. These are going to be like your well-established businesses with long histories of success. They're going to be consistently profitable. They have stable revenue without huge amounts of growth, but they typically don't have like huge declines. And then some of them do have dividends. That's not necessary. That doesn't necessarily make it a value stock, but some of them do offer dividends. But think like JP Morgan, Johnson and Johnson, Goldman Sachs, Bank of America. These guys, if you pull up the chart, right, it's not going to be like that ramp. It's going to be like a slow, steady tick, but it's going to be to the upside, right? So over time, they're just growing. It's just not going to be as drastic as a growth stock. But nonetheless, the idea is that you balance your portfolio with stocks of both types. Because what happens is when these guys take huge swings like they are right now, these guys can kind of balance it out, right? So you're not going to have a portfolio that's like whipsaw all the time. You'll have the value stocks to kind of balance things out. All right, so again, fundamental analysis. This essentially, again, this is going to help you determine a stock's fair value, a company's fair value, which a company may not always be trading at its fair value. Sometimes it's overpriced, sometimes it'll be underpriced, and it just depends. But again, this is why we do fundamentals, so we can determine how much we think a stock is actually worth. All right, so you have qualitative and quantitative. Qualitative, and it's like quality. So think about like brand value, management decisions, their financial performance. Quantitative, that's purely numbers based. And we'll talk about their financial statements. All right, so there's our sectors again. And again, thinking long-term, you absolutely want to diversify and have exposure. One cool way is to find the strongest companies in each sector and then identify those competitors. And then you can start to build out your portfolio based on that. So again, we just went over the sectors, but just so you guys have them, there's another shot of them. And then ETFs, again, ETFs are really cool. For long term, because again, you don't have to go in and buy like all these different stocks. You can just buy an ETF that will give you exposure to them. And then as that industry grows, then your ETF will grow. And again, your portfolio will grow over time. And some of these ETFs actually do pay dividends as well. All right, so research strategies. There's a ton of different ways to attack your research, your due diligence. So the first is going to be the top-down strategy. This is going to start with individual companies. It's going to start with an industry, and then you're going to narrow down to the strongest companies within that industry. That's the top-down. The bottom-up is the opposite. So that you're going to start with an individual company and then expand out to the competitor. So if we're talking about like EV, you might say like, let's look at Tesla first, right? Tesla is like the king over there, in my opinion. So there's Tesla, but then once you research Tesla, then you go to NIO and Acromoto and XPEV and Lucid, and then you can kind of compare them with each other and figure out which one you think is the top contender for Tesla. Your industry analysis. Annual reports for a company can give you a good idea of how well they're operating. You want to compare reports and data from different companies within that industry to get an overall outlook. Again, an annual report is a heavy document. If you're someone who's day trading, scalping, this is not for you, right? You don't need to dig all this up. You just need to have like a nice catalyst, which it's a real contrast. So this is, again, the longer you're going to be there, the more you want to dig into that company. Business model analysis. This is a huge thing. Research the business model of the company. Ask yourself, is it sustainable? Can they scale? How did this company adapt during COVID-19? I think COVID-19 really showed us what companies can kind of step up to the plate, what companies kind of maybe peaked during that time. Different things like that. So like if you look at like Zoom, for example, I know Zoom in 2020, I want to say Q3 earnings, they had like this really crazy profit. They broke all these records for the company because everyone was at home and on Zoom, right? But then the next earnings, right? The vaccine rolled out, people were starting to go back to work. They were like, I don't know if we can do that again, right? I don't know if we can hit those numbers again that we hit during COVID. So the stock actually suffered. So those are things to pay attention to, just how companies can adapt and how their business model can be affected by different things going on. Again, finances, check the balance sheet, financial statements, income statements to see if the company's profitable. On these financial statements, you really are looking for trends, and we'll dig deeper into that, but you're looking for trends in their finances. Are they consistently profitable? Are they, consistently losing money? Things like that are very important to pay attention to. All right, so management, research the people in charge. Strong management can build investor confidence. One thing I love is that most companies are going to have an investor relations page. You can literally Google it and they'll have like the company, they'll have the executive team, they'll have little bios, little pictures, and you can actually see who's in charge and see what they're about. A lot of those penny and OTC stocks don't have that. You can't see who's in charge. And you'll notice the people in charge they make a big difference in investor confidence. If you guys notice, a lot of times, like you'll get little headlines from like Yahoo Finance or Bloomberg, and they'll come out and say like, I don't know, when Amazon hired the new CEO, right? They were like, Amazon's new CEO, formally here, like he came from here, right? So they always want to kind of ease you in and let you know that this person is experienced and that they have a good track record from another company that's really strong. So that's something they always slot in there, is like where this person came from. And one more example on management. Actually, no, we'll go on to the next one. So valuations. Does the current share price make sense for the company? Is it overvalued or undervalued? This is huge, like AMC, for example. If you look at AMC, I think it was January before the COVID crash in 2020, AMC was trading around $7 a share. So fast forward, AMC got pumped up to like $72 a share and people were buying it. Now, some of those people were just there, to pump it up, but some people were seriously buying AMC at $72 a share. Now, a company that was really impacted by COVID and the price was like 10x, that makes no sense from a valuation standpoint, right? No sense at all. COVID did not do any favors for AMC as a company, financially or anything else. So now they are starting to recover, but a $70 price, that makes no sense. So always ask yourself, does this share price make sense? And if it doesn't, figure out why, right? So price targets, analyst ratings. What do the analysts say? Now, the analysts are going to be kind of scattered. They'll come from all places. I know Tesla, Bank of America, I don't know if it was last year or 2020, but they gave Tesla like an $80 price target. For me, that was very low, but that was their price target. So you want to compare more than one analyst rating and form your own opinion to make sure that it makes sense. Because again, some of the analyst ratings can be really extreme. Earnings. Definitely for your long terms, you want to listen in on those earnings calls. Companies they're gonna report on a quarterly and an annual growth basis, and they'll also give you forward guidance, basically telling you how they plan to perform in the future. If they didn't hit all their benchmarks and their indicators, they'll come out and say like, here's our plan to address it. Or they might lower guidance, like Snowflake. Snowflake recently lowered their forward guidance, and as a result, the stock took a huge hit. It took a huge hit after hours after that call. But this is an easy way. It's kind of like a report card. You get a little snapshot of how that company performs. And then keywords. A lot of times when you're brand new to the market, you don't really know where to start, right? So keywords, you can just hop on Google, and this can kind of get you started. So you can Google words like EV or FDA approval or vaccine or what have you. And that can like lead you in the direction of some strong companies pertaining to that particular topic. All right, so I love this quote. If you don't have a competitive advantage, don't compete. All right, so economic moats. This is going to refer to a company's ability to maintain a competitive average or advantage over its competitors to protect its long-term profit and market share. So think about Apple, Tesla, Netflix. Kind of want to take Facebook off, kind of want to take Meta off, but Starbucks, Amazon, companies like that that are really trailblazing their industries. A competitive advantage is any factor that allows a company to provide a good or service that's similar to its competitors, but at the same time, they outperform them in profits. A good example of a competitive advantage is like a low cost advantage. So if someone has like cheap access to raw material or patents or proprietary technology, they really can have that competitive advantage over the other people in that industry. Again, you want to compare the metrics of 2 or 3 competitors. Every company is going to be defined partially by its competitors. So just looking at them in each line of the company's business, like Amazon has more than one, but you can determine, how strong that company really is. Things to compare, you want to compare financials, PE ratios, business models, and then their future plans for growth. So creating a moat, you have a cost advantage. Companies with a huge cost advantage can undercut prices of anybody that tries to get into that industry. So think about Amazon. A lot of times you can be at the store, or you can be, you could be in a physical store and you can buy something cheaper on Amazon. Even though you're at the store, it's actually cheaper to buy it through Amazon. Size advantage, once a company reaches a certain size, it gets that economics of scale. They can produce more goods and services at a lower cost. And that reduces costs in financing, advertising, and production. They totally dominate. Think about McDonald's in the fast food world, right? They have like some of the cheapest fast food prices, and that's because of their size. They can do that. High switching costs. This reminds me of like cable companies back in the day, or cell phone carriers. When companies establish themselves in an industry, suppliers and customers may have to pay a higher cost to switch and do business with someone else. You'll notice though, over time, that trend has kind of come down some. They still have penalties and things, but you will have like competitors willing to pay your switching costs because they want to encourage you to leave if you want to leave. It makes the space more competitive. And then intangibles, things such as patents, brand recognition, government licenses, and other things. Strong brand recognition, it allows these types of companies to charge a premium price for their products over competitors. So think about like Starbucks, right? If you went to McDonald's and they tried to charge you $10 for coffee, you probably would drive off, right? But at Starbucks, you just hand over the card because that's what they're known for. And no one blinks an eye because it's Starbucks. So that's just one way like branding can really change how we see things. All right, so management. Is the company still run by its founders? Obviously, if a company's older, the founders may not still be with us. So that's one thing. But also pay attention to how the management is shuffled around. Like, are there people in and out often? That's a red flag to me. Which Boeing, I do love Boeing. It's one of my favorite companies, but they have a lot of turnover. Like people are in and out of there like crazy. Again, look at the bios of the people in charge, see what experience they have. You can also see this stuff on the SEC filings and on the company's websites. Another thing to look at is to see the management, see if they hold a high proportion of shares and what amount of the float is held by institutions. Institutional ownership percentages indicate how much analyst coverage a company gets, as well as factors including trade volume. So if a company has like high personal ownership by the managers, that's a good sign. If a company has low ownership, that can be a red flag. Like I know at one point AMC was like, they wanted to add more shares because the management didn't own that many shares and they wanted to vote on it, but like the shareholders voted it down. It's kind of like the company doesn't have the will of the car anymore. So that's a red flag to me. But you can see all that stuff. You can also see it on FinViz. FinViz is a good place to see that as well. All right, so finances, again, these are the 3 main things I look at: balance sheet, income statement, and cash flow statements. Again, balance sheets, they just give you a record of the company's assets and liabilities and equity at a specific point in time. You want to pay attention to those cash levels, their ability to pay their liabilities, their short-term liabilities, and then their long-term debt. Now, debt isn't necessarily a bad thing. It just depends on what the company does. A lot of companies are capital intensive, meaning they require a lot of money to function and produce their products. But other companies don't require as much. All right, sorry, y'all. So you can compare like the debt to equity ratios against different companies to see how they fare with each other. The income statement, again, income statements, they're going to measure a company's performance over a specific amount of time. They offer information about revenues, expenses, and profit that was generated as a result of their operations for whatever set period you're looking at. Then you also have your cash flow statements. This is just a record of their inflow and outflow over a period of time. So again, when you're looking at finances, your biggest thing you're looking for is trends. That is the biggest thing. These numbers can get really big and crazy, but all you're looking for is like, are they consistently profitable? Are they consistently, is it steady? Is there no real change? Are they on a decline? If you look at something like Beyond Meat, Beyond Meat's finances, they're actually losing money. Like they're consistently losing more money, right? That's a red flag. When you look at the finances, start with the revenue, profit, and margin trends. You want to look up revenue and net income trends for the last 2 years at least. And my favorite place to look up financial information is Bar Chart. Bar Chart has literally all 3 of these listed there for you. And it's really, really easy to kind of digest and analyze. I love it over there. These sites provide like historical charts. They show you a company's price fluctuations over time, and they'll give you that PE ratio, which is huge. You should also review profit margins again to see if they're generally rising, falling, or remaining the same. And then your PEs. I do want to talk about PE ratios. The PE ratio relates a company's share price to its earnings per share. There's 2 types. You have your forward and your trailing. And this is calculated by dividing the current stock price by the earnings per share. This is one of the most popular tools that are used, that's used to compare companies for their relative value. The PE ratio shows you what the market is willing to pay today for a stock based on its past or future earnings. So a high PE ratio could mean that a stock price is overvalued, like it's too high relative to its earnings, and possibly overvalued, or that investors are expecting high growth rates in the future. So if you've ever heard anyone like debate Tesla, you'll know the bears, a lot of them, their case is that Tesla is overpriced. A lot of people think that Tesla was overvalued, which it's definitely come down from the highs. But Tesla's PE ratio compared to every other automaker, the auto industry as a whole, it's up there. Okay, it's very high, but it is a growth stock. In my opinion, it is a growth stock. And so it has the potential to actually be worth that high price. So that's kind of a huge debate on Tesla. And then a low PE could indicate that a stock price is low relative to its earnings. A company's PE can also be compared against others in that industry or against the overall S&P. So it's really cool to kind of see how the PEs fare with each other. And it's actually cool now because a lot of the stocks are down from the highs. So you can see the PEs are kind of starting to look a little better. And again, this helps you determine whether a stock is growth or value. So just remember, a high PE, it could mean that it's a growth stock, but it could also mean that it's extremely overpriced. So that's where the research comes in. All right, so annual reports. You can look up, there's a 10Q and a 10K. And again, these are heavy reports. So this is not something you want to take lightly or do if it's just a quick day trade. Quarterly SEC filings are also cool to look at, but this is going to break down the company from top to bottom. As a long-term investor, this is information you're going to want to need, you're going to want to have and be aware of. But again, this is not light reading. So it's only for your super long-term holdings. All right, so future plans. You definitely want to find out the revenue and profit estimates for the next 2 to 3 years on your company. You want to look at long-term trends affecting the industry, company-specific details about partnerships, joint ventures, intellectual property, new products and services, news, like if a company has news about a product that really brought them to your radar, that's when you kind of want to go a little deeper. You never want to go long-term based on like one little thing that you saw, right? You always want to dig a little deeper. And then your forward guidance, you get your forward guidance during those earnings calls. All right, so risk, right? There's always risk involved. If anyone ever tells you that the stock market is risk-free, you should run for the hills because there's always risk. Make sure you understand risks that are like industry-wide and also risks that only pertain to your company. So think about things like outstanding legal or regulatory matters. Think about, is management making decisions that lead to an increase in the company revenue? Is the company eco-friendly? What are some long-term risks that could have, come from that company not going green? Things like that. So one thing we tell our students, like, always stay objective, always remain objective. When you're analyzing stocks, you have to play devil's advocate. You have to imagine the worst case scenario and how it could affect the stock. Think about it as preparing for a debate, right? So if I want to invest in a company long term, I want to prepare myself for a debate. So I want to have my bull case and I also want to have my bear case. So if someone approaches me to talk me out of it, I want to have all my points in line to counter them, but I also want to be aware of what they might say to talk me out of it, right? So you always want to see your stock from both angles, because again, there's no such thing as a risk-free investment. Let's see. And I think, yep, that's our last slide. So now I want to get into, I actually want to break down my play that I had yesterday. I actually had a trade yesterday on Tesla, and I had a 10K profit. So I really wanted to break it down for you guys. Does anyone have questions about the presentation? I know I just jumped off the screen. I don't see anything in the chat. Okay, good deal. Oh, I see a hand up. Can you put your question in the chat? I'm happy to answer whatever it is. Okay, so I'm gonna pull up a 15-minute chart on Tesla. And again, we just talked about these technicals, but you can see I have my EMAs here. There's my 50, my 200. There's my MACD. There's my RSI, and there's this monster of a stock, Tesla. So if you'll notice on Friday, actually this setup started on Friday, right? So I watched Tesla Friday. I actually did write it down. And this goes back to our technicals we talked about. There's our resistance, there's our support. You can see we were range bound, right? We were just bouncing around like a ping pong ball. So I was like, I rode Tesla down from the high. That was my first put on Friday. And then I was like, okay, well, it's actually forming a pattern and I'm not comfortable swinging this because look at your trend lines, right? So let's look at this. All right, so we had a bit of a pattern here. So I was like, I'm not comfortable swinging my puts because I thought it could break out of that upper trend line, which it actually did, right? So then Friday, let me jump down to a 5. All right, so Friday, right, we broke out of that trend line. So that could have been a swing to the upside. Mind you, I was in puts, so shout out to getting out of that. So I'm glad I got out of that situation. But anyway, so there's your upswing. That could have been a nice swing on put or on calls. But I do not like swinging in this market. It's very headline driven, very sentiment driven. And I just thought it was not a good, smart decision. So I didn't do it. But anyway, yesterday we opened up, we hit a high of 866.14. And then we rejected, right? We rejected. So let me jump down. Oh, that's fine. So there was the first drop, right? There was a nice opportunity. Notice, look at your MACD. We talked about our MACD crossed down. So that's a sell signal. Our RSI was too hot. That's a sell signal. And then look at our candles, right? We're getting lower highs. So that's also bearish. So there's like 1, 2, 3 confirmations. And then you tack on the selling volume, right? The sellers came marching in. So there was the first drop. I actually overslept. So I did oversleep through my first setup. I was a little upset about it, but it's okay. Because what happened was we actually hit a level of support here. Here's my lower trend line. And we consolidated, right? We consolidated for a minute. I had lunch. There's my upper trend line. And so once we broke out of that bottom trend line the second time, I was able to just re-enter, well, not re-enter. I was able to enter that trade. I had 6 puts. I had an 840 strike and I rode this thing down. And then my profit, it was $10,005 off of 6 Tesla puts. And then you can see today, again, a little bit of an upper trend line and it's trying to break out of that. So one thing I will say, you did have a pullback here, but look how it's like sitting on your EMA 50, right? So we're not yet, it did reject the 200, but it looks like they're trying to defend this EMA 50 right now. So we'll see if we drop any more. I don't like that candle. That's actually, yeah, the buyers are in. So we'll see what happens with Tesla later on this afternoon. But for right now, I would not short this just yet. It looks like it wants to recover just a bit more. But yeah, that's all I had for you guys. Does anyone have any questions? I see hands up, but I don't know how to answer. Yeah, I'm pretty sure the recordings are available. They have been in the past. Correct me if I'm wrong. Yeah, what's your question?
Yeah, all the recordings will be on TimingResearch.com as soon as I can get them posted.
Okay, perfect. Thank you, David. Hey, Michael, what was your question? Yeah, I wake up every day and think about his Amazon average cost, and I lose sleep about it. It's ridiculous. But if Amazon wanted to go back to 700, we could all get in. Hey, Michael, what was your question? And thank you, Kim. If anyone has like any stocks they want me to analyze for them, I'm happy to do that too. I know we have a few minutes left, and I actually love charts. I'm gonna sit here and stare at these charts after this presentation's over. I'll be here until 4. Yeah, let's look at Lucid. You like Lucid short term or long term? All right, so if you look at Lucid, let me zoom this up a little bit. You do have a bit of support here, but one thing I do not like, look at your MACD. This is a daily, so this is like one candle per day. So you do have a bit of support that it's kind of been holding here, but this 50 crossing that 200, this is called a death cross. So when your 50 EMA or moving average crosses down below the 200, it's actually a death cross, and it signals a really strong downtrend. So your level on here, let's see, the low is like 2177. Yeah, I'm gonna put in a little support here for you. 2177 is your level to watch, but I would short this puppy. If it breaks that 2177, I would absolutely short it, because this death cross is coming in hot. But if you look at like short term, you might get a bounce today. Let's see. Yeah, so there's your bounce. You got resistance up here. What did it hit? 2505. And look how hot your RSI, your MACD, and then you have a reversal candle already too on the 15. So yeah, I'd keep your eyes on this, but this could be a good short. Let's see. But I do like Lucid. Don't get me wrong. I do like Lucid. It's just the market is not for the bulls right now, unless you're in commodities. It's definitely for people in nickel. Let's see. So this is the daily on Bank of America. Does anyone remember what this pattern is? We totally just talked about it. And if anyone gets it right, I'll be so excited. This pattern right here. Does anyone remember what that is? Yeah, that's a double top. Good job. So there's your double top, right? We hit that resistance twice, came down. You broke your EMA 50. Yep, you can call it McDonald's. That's fine, as long as you know how to trade it. It doesn't matter. But yeah, that's your double top. There's your neckline. In this case, this is a nice drop. This is a nice drop. So Bank of America, let's see, what was our low yesterday? 38.21, 38.17. So we got a new low from yesterday already. Jumping down to the 15. This 15 looks like it wants to come down some more. So yeah, this looks a little bearish to me. This looks super bearish, but I would watch this level here. Your pre-market. You see how we had a low pre-market of, what is it, 37.94? I think it's going to retest that. So yeah, I would short this below that. I think you can get there too. And your MACD looks like it's ready to cross as well. And then SOFI. I hope this was helpful. I love showing people how to make money in the market. It's a lot of fun. It is a whole lot of fun. All right, so SOFI on this daily, there's another death cross. Just remember, the opposite of the death cross is the golden cross. So if you guys notice, my EMA 200 is cut off right here. And that's because SOFI, it just IPO'd not too long ago, right? So we don't have a full 200, but we did start here, right? Day 200, and now we can see what's going on. But that being said, when your 50 crosses over the 200, that's called a golden cross. And that signals a strong uptrend. And you can actually see too, look at the bottom of this trend line. Like you have a trend line here as well. And we broke it. Look at your, also remember to look at your MACD and RSI, but this was overheated. So there we go, overheated. We hit a high, broke our 50. There's our death cross. And then if you notice, which this is a longer time frame, this is a daily, but you're getting lower highs. You're getting lower highs. And so anytime you're getting lower highs, that's bearish. This looks like it hit a low of 882. What was that? On the 24th. So it looks like it's going to try to get back there. That you see where it's headed. So 882 is the level to watch here. Sorry, you can hear my little puppy. Her name's Piper the Sniper. Sorry, she's barking at the mailman. But yeah, so the EMA, basically it's just smoothing out your price action. So give me 1 second. I'm sorry, y'all. Okay, sorry about that. My dog is going nuts. So the EMA or the moving average, right? They're both going to smooth out your price action. She's actually really small. She's a very small multi-boot. So you see how this is kind of choppy. It's like up and down, up and down. So SOFI is a hard example because the moving averages are kind of cut off here, but this is basically going to smooth out your price action. Like it's just going to smooth out on average how your prices move. So like, let's say, let me just pull up a random stock real fast so you can see a full one. I'm just going to pull up Apple, right? So let's clean this up. So if I take off this, right, I just took the price off completely. You can use the moving averages to see how the price has actually moved. It smooths out the price action. And so the 50 and 200 are super important. I call the 50 the anchor. Typically, if you're trading above the 50, like the white one, then you're on an uptrend, right? When we break below the 50, we're typically in a downtrend. And then like over time, your stock is literally just gonna, the buyers are gonna fight to keep it above the 50. The sellers are gonna fight to get it below the 50. And it's so on and so forth. So that's a cool way to eyeball price action. But again, it's literally just smoothing out that price action over the last 50 days. And then for the EMA, it's gonna put more emphasis on the most recent price action. So it's going to put more emphasis on the most recent, but the simple moving average is going to even it out. It's just going to be totally evened out across all the days. Does that make sense? It's just the EMA is better for short term because it updates a lot faster. But for your long term, you want to have that nice, smooth, simple to smooth everything out and get the best prices and the best entries. This is that what allows. Oh yeah, so there's paper trading for sure. So Thinkorswim is a really good platform. They have it's called On Demand. So you download Thinkorswim to your desktop, and it is overwhelming, but it's okay because it's paper money. But you'll log into a live account. You don't have to fund it. And what you do is you click on this little button that says On Demand, and it'll allow you to do something called back testing. This is my favorite. I'll show you some other things too, but for back testing, you can basically go in on previous trading days and you can live trade the market. Like it's literally like real time candles, patterns, all that real time entering, exiting trades. But it's fake money. Now you can also paper trade. I don't like paper trading because it happens during the live market and I like to watch the market. But when you're brand new and you want to start and you want to practice, paper trading is fine. I prefer to back test because I can do it at midnight. I can do it on Saturday. And I can actually use the real market time to watch the market. But I definitely think everyone that has never traded, or even if you have traded, like I still back test I think it's a good practice to keep your skills sharp by paper trading and back testing. But you can do it on E-Trade, you can do it on Webull, you can do it on trading, not trading. Yeah, TradingView has back testing and paper trading, but I don't know if you can do options. I think it's just shares. And then what else? I know TradeStation has paper trading. There's a lot of platforms, but yeah, you can definitely trade fake money, and I recommend it. And we actually have a free community if anyone wants to join. It's just a trading group, and me and my partner in there every day. And it's pretty fun in there. It's just everyone's just learning. And I'll drop the link in here if I can get it. I thought I had it pulled up already. Neo, yeah. While this is loading, let me grab Neo. All right, so Neo, on this daily, if you notice, it's getting lower lows as well. That's like the story of our lives right now, but that's okay because again, those companies that you guys think are strong companies, it's okay to buy them. Like Warren Buffett said, you can buy the strong companies when they're on the operating table. Now, what I will say is it's kind of like you want to pinch a little off, right? So we haven't found a bottom yet in this market. So what I say, buy all the shares that you're ever going to want right now, you could probably get them cheaper, right? Because we're still in this downtrend. Now, what you can do though is buy, pinch a little off as we drop. And then once we reverse, and then you can kind of like just add on as you go. You don't want to get caught up trying to time the bottom. That's one of my pet peeves. People are always like, we're going to bounce today. Like, you don't want to get into that. Just trade what's in front of you. Trade what's in front of you. Be objective. I tell my students to make sure when you are entering a trade, you have a plan for both sides, especially for my scalpers and day traders. If you come into the market and only say, I'm a bull, no matter what, I'm just going to run calls, you're going to lose money because the market doesn't always go up, as we can see. There's downside too. So just keep that in mind and just stay objective. But yeah, for my long-term people, this is a great time to pinch off a little and build up your portfolios, average down, average up. And then, just whenever we do reverse, you'll be prepared, right? You can compound. But Neo, if you notice this September 2020, those levels, that looks like where we're headed, which we pretty much are there, honestly. What's this low? Like 1780? Yeah, I would not be surprised if we got back there. I don't know if there's any gaps on this chart, but yeah, this looks bearish. I would not be surprised to see it come back to this area here. And no, we don't have a Discord, just the Slack. And we do we have something called a Bay Pass, and we do like live pop-up trading sessions with everyone. And then on Sundays, I go over all my setups. Like I know this past Sunday, I gave everybody my Tesla setup. So some of them caught that too. But yeah, I'm really big on making sure everyone understands how to chart, because like if you can chart and identify opportunities, then you don't need us to call out the plays. And I think that's the most important thing, is that everyone's like self-sufficient. Because you guys, there's more eyeballs, everybody can see different things, and there's more opportunities for everyone if we're all looking at something different. Because there's so many ways to make money in the market. So yeah, I don't do call outs. We do post a watch list though. Every week I'll post all the stocks I'm watching to our Instagram. But yeah, that's all I have for you guys. Does anybody else have any questions? Thank you so much for having me, and happy International Women's Day.